Today is 16th February, Monday, and let's dive straight into a market story that seems impossible at first glance. Silver to $1,000. I know what you're thinking. That's 10 times the current level. That's extreme. That sounds like hype. But here's the thing. History doesn't lie. Precious metals cycles repeat. And right now, two specific ratios, the Dow priced in gold and the gold-silver ratio, are signaling exactly what they signaled before the 1980 precious metals surge. I want to be clear. I'm not here to pump silver. I'm not here to sell fear or greed. This isn't a to the moon tomorrow video. What I'm showing you today is raw data. The numbers, the historical patterns, both sides of the argument, so you can decide for yourself. This is about real analysis, not clickbait. Before we dive deep, I want you to engage. Comment below. Where are you watching from today? What city? What country? I see people tuning in from the US, Canada, UK, India, Australia, literally all over the world. And while you're at it, tell me your gut feeling. Where do you think silver goes this year? Pull back first or straight up? Let's get a sense of what the community is thinking. Now, let's break down the thesis. Two ratios are all you need to understand this. First, the Dow priced in gold. Second, the gold-silver ratio. When both ratios flip from one extreme to the other at the same time, silver doesn't just move, it explodes. Right now, they're positioned exactly where they were before the biggest bull market in modern precious metals history. The Dow-gold ratio is simple in concept but incredibly powerful. Take the Dow Jones Industrial Average and divide it by the price of gold. That tells you how many ounces of gold it takes to buy the entire Dow. High numbers mean stocks are expensive relative to gold. Low numbers mean gold is expensive relative to stocks. It compresses a century of market psychology into a single line. Let's go through history. In 1929, the Dow-gold ratio peaked. Everyone was all in on stocks. Gold was ignored. Then, in just 4 years, it crashed to 2. You could buy the entire Dow with 2 ounces of gold. Peak optimism to peak pessimism in 4 years. The ratio climbed again through the 1940s, 50s, and 60s, peaking in 1966. Extreme stock optimism again, gold dismissed, and then it crashed again. By 1980, the Dow-gold ratio had fallen to 1. 1 ounce of gold could buy the entire Dow. That's extreme. That's what happens when these cycles complete. Then the ratio reversed. Through the 1980s and 1990s, it climbed, peaking in 1999 during the dot-com bubble. Optimism in stocks was sky high, gold forgotten, then it crashed again, falling to around 6 by 2011, down from roughly 45. A massive move. But here's the key point. I don't believe 2011 marked the true bottom. Global debt exploded afterward. Central banks printed trillions. QE became permanent. Debt levels reached all-time highs. Past cycles show that true Dow-gold bottoms occur when debt is manageable, either through deflation like the 1930s or inflation like the 1970s. Today, debt is far from manageable. Government debt to GDP ratios are at record highs. That tells me the real low is still ahead. I expect this ratio to approach the 1 level we saw in 1980, not the 2 we saw in 1933. Why? Post-1971, gold is free to price naturally. No gold standard constraints remain. Debt levels are higher. The forces are stronger than ever. Let's be conservative. I'm not calling the exact bottom. Timing tops and bottoms perfectly is impossible and risky. But a mid-cycle target, a high probability zone, is 2.5 for the Dow-gold ratio. That's achievable based on historical midpoints of past cycles. Today, the Dow-gold ratio is approximately 9.82. Dow is about 49,500, and gold is roughly $5,042 per ounce. If the ratio falls from 9.82 to 2.5, that's a factor of 3.93. If the Dow stays flat, gold must rise by the same factor, implying a price around $19,800 per ounce. That's not hype, it's math. Some may ask, what if the Dow crashes? What if we see a 2008-style collapse? History shows that stocks may dip temporarily, but precious metals continue their move. In the 1970s, equities bottomed earlier, but silver and gold peaked later. This suggests the Dow may stay flat or even rise slowly while silver surges. Timing and magnitude vary, but the overall cycle continues. Next, the gold-silver ratio, where silver enters the equation. This ratio shows how many ounces of silver buy 1 ounce of gold. High numbers mean silver is cheap relative to gold. Low numbers mean silver is expensive. Today, this ratio is about 65, historically elevated. Silver is cheap relative to gold. At the end of every major precious metal cycle, this ratio collapses. In 1980, it fell to 14. That's massive compression. Silver dramatically outperforming gold. Silver is smaller than gold. When capital flows into precious metals, gold moves first because it's larger and more liquid. Then silver moves faster, more volatile, higher percentage gains. This explains why the ratio compresses violently. Let's stay conservative. I'm targeting 19 for the gold-silver ratio, not 14. That reduces risk while capturing most upside. If gold reaches $19,800 and the gold-silver ratio compresses to 19, silver hits $1,040. Two ratios, one mathematical conclusion. Silver could reach 4 digits. The path is not linear. Corrections will happen, volatility will hit, but history and math point strongly in this direction. Now that we've laid out the ratios and the math, let's address timing because that's what everyone wants to know. When will silver actually hit $1,000? The honest answer, I don't know the exact date, and neither does anyone else. Anyone claiming they do is misleading you, but we can look at historical patterns to estimate a reasonable timeline. This current cycle mirrors the 1970s in many ways. The Dow-gold ratio today is in the same zone it occupied between 1973 and 1976. Back then, the ratio continued its downward trend until 1980, which marked the peak for precious metals. If history repeats itself, that suggests roughly 4 to 7 more years for this cycle to fully play out. That puts the peak somewhere between 2030 and 2033. That's when silver could reach or approach the $1,000 target implied by the ratios. It's important to understand this. The journey will not be straight up. The 1970s were filled with corrections. Silver dropped 50% in 1975 before surging to its ultimate high in 1980. If you panicked and sold during that correction, you would have missed the rest of the move. That's why recognizing the full cycle is crucial. You must separate short-term volatility from the long-term trend. This is also why understanding your time frame matters. Are you trading on hourly charts or investing based on a multi-year thesis? These are completely different strategies with different rules. The $1,000 silver scenario is a multi-year thesis, requiring patience, discipline, and conviction. You must be prepared for corrections that test your resolve along the way. Now let's cover the bearish risks, because no analysis is complete without considering the other side. First, the Dow-gold ratio could stabilize at current levels. Just because previous cycles fell to 1 or 2 doesn't mean it must do so this time. The global financial system today has tools central banks didn't have in the past. Intervention could limit the move, though history suggests extreme ratio shifts tend to occur over full cycles. Second, deflation could dominate instead of inflation. This thesis assumes debt will be managed via inflation, as it happened in the 1970s, but debt could also be resolved through deflation, like the 1930s. In that scenario, cash retains value, gold holds steady, but silver, which has significant industrial demand, might underperform. Think of the decades-long Japanese deflation experience, no major bull market for precious metals. Third, the gold-silver ratio might not compress as sharply as in 1980. That year, the Hunt brothers' silver buying created extraordinary pressure on the market. Without a similar concentrated event, the ratio could only compress to 30 or 40 instead of 14 or even 19. Silver would still outperform gold, but the final price would be lower. Fourth, governments could intervene. In 1933, the U.S. confiscated gold. In today's environment, authorities could impose taxes on gains, restrict trading, or enact other measures to prevent the cycle from completing. Precious metals' rise attracts attention, especially from those in power who view gold and silver as competitors to fiat currencies. Fifth, timing risk. Even if this thesis is correct, 4 to 7 years is a long time. Personal circumstances can change. You might need funds unexpectedly, or lose conviction during a correction. The thesis being right doesn't guarantee personal profit. These are real risks that every investor must understand. With that said, let's discuss confirmation signals that tell us whether this thesis is still valid. First, watch the Dow-gold ratio. If it reverses and rises above 12 or 15, that would indicate a risk-on environment and that precious metals may be losing momentum. The thesis would need reassessment. But as long as it trends lower, the setup remains intact. Second, monitor central bank behavior. Are they still expanding balance sheets? Are they buying gold? Around the world, countries like China, Russia, Poland, and Turkey are accumulating gold, not dollars. This signals a long-term belief in gold's value and confirms demand-side strength for precious metals. Third, watch physical premiums. When physical silver trades at a large premium to paper prices, that signals the market is tight. Recent Shanghai premiums hit 43%, and JD.com premiums reached 91%. Dealers struggle to source metal, paper markets and physical markets will eventually align, and it's likely paper prices that adjust upward to meet reality. Fourth, debt levels and inflation. The thesis requires global debt to become unmanageable, forcing either default or inflation. If governments suddenly become fiscally responsible, balance budgets, or reduce debt, the setup weakens. But that's not happening. Debt continues to rise and inflation persists, confirming that the conditions for a full precious metals cycle remain intact. Fifth, the gold-silver ratio itself. If it starts rising again, breaking above 80 or 90, silver would no longer be outperforming gold, signaling potential trouble for the thesis. But as long as the ratio continues to compress, silver is likely to outperform in the final leg of this cycle. Now let's dive into why silver moves harder than gold in these cycles. It's about market size and dual demand. The silver market is tiny compared to gold. Above ground silver is worth about $50 billion, while gold exceeds $10 trillion. Even a small inflow of capital into silver causes massive price moves because the supply cannot absorb the demand. Silver also has industrial demand: solar panels, electronics, medical devices, electric vehicles. Investment demand is growing simultaneously, two powerful forces competing for a limited supply. This is why silver's moves are more dramatic and why the gold-silver ratio compresses during the late stages of a cycle. Capital is literally trying to squeeze into a small market. Here's a practical question. Are you stacking silver right now? Physical bullion, miners, ETFs, or just waiting for a pullback? Drop your strategy in the comments. Are people positioned for this potential 4-digit scenario, or are they skeptical? The discussion itself gives insight into market psychology. Let's summarize the numbers again so it's crystal clear. Current starting point: gold 5,042s per ounce, silver 77.42 per ounce, gold-silver ratio 65.13, Dow roughly 49,500, Dow-gold ratio 9.82. Conservative targets: Dow-gold ratio falls to 2.5, gold 19 to 800. Gold-silver ratio compresses to 19, silver 1 to 42. Timeline: 4 to 7 years, suggesting 2030 to 2033. Now, as we move into the final part of this breakdown, I want to focus on how you should think about this thesis in real terms. This isn't about blindly chasing $1,000 silver tomorrow. It's about understanding the framework, the cycle, and positioning yourself intelligently. You need to manage risk, understand the volatility, and know your personal time horizon. If you are a long-term stacker, this thesis is a roadmap. Stack responsibly. The cycle isn't complete yet. The gold-silver ratio hasn't compressed fully. There's more upside to come. But don't use money you need for rent, bills, or emergencies. Only stack with funds you can afford to hold for 5 to 7 years. This is a multi-year cycle thesis, not a quick flip. Patience and discipline are critical. If you're a trader, this framework tells you to look for pullbacks to add exposure. Volatility will occur. Corrections of 30, 40, even 50% are likely, as history has shown. Use those dips strategically. There are opportunities to accumulate or increase exposure without overextending. Stop losses, position sizing, and discipline matter more than ever in these phases. Emotional trading is the fastest path to losses. Skeptical? That's fine. Watch the ratios. Let the data speak. If the Dow-gold ratio starts rising, if the gold-silver ratio expands, if central banks pause gold accumulation, the thesis is likely wrong. But if these indicators continue trending as outlined, the cycle is in motion, and silver is likely to outperform dramatically. This is how you separate hype from mathematics. Let's revisit why these ratios matter. They're not arbitrary. They reflect long-term capital flows between asset classes. When confidence is high, money flows out of gold and silver into stocks, bonds, and real estate. Gold and silver are forgotten, dismissed as outdated or irrelevant. But when confidence breaks, debt becomes unmanageable or inflation erodes purchasing power. Capital floods back into hard assets. The Dow-gold ratio collapses, and precious metals surge. We're in the middle of that process right now. Gold has been rising steadily for years. Silver is beginning to follow more dramatically. Central banks' credibility is being questioned. Debt is at all-time highs. Inflation remains stubborn. The conditions are aligning for a major move, and the historical patterns suggest this cycle could be comparable to the 1970s peak. This is why silver could reach 4 digits. The math from the Dow-gold ratio and gold-silver ratio supports it. If the Dow-gold ratio falls to 2.5, gold rises to $19,800. If the gold-silver ratio compresses to 19, silver hits 1,042s. Two ratios, one conclusion, a mathematical certainty if history repeats. Corrections and volatility won't change the endpoint. They just determine the path. Now, risk management cannot be overstated. Even if this thesis is correct, personal circumstances matter. You could be forced to sell during a correction. You could lose conviction during market swings. A correct thesis doesn't guarantee personal profit if your risk tolerance, position sizing, or time horizon isn't aligned. Understand that fully. This is why multi-year patience and careful planning are essential. What are the key confirmation signals to track? First, the Dow-gold ratio itself. As long as it continues trending lower, the setup remains intact. If it reverses sharply, that's a warning. Second, central bank behavior. Are global central banks still accumulating gold? This is a crucial piece of the puzzle. Third, physical premiums. Are physical silver markets tight relative to paper prices? This indicates supply constraints that will push prices higher. Fourth, debt and inflation trends. Debt continues rising, inflation persists, conditions remain favorable for precious metals. Fifth, the gold-silver ratio. Compression is critical. If it rises instead of falling, the silver thesis weakens. Let's examine why silver moves harder than gold. Market size is the key. Total above-ground silver is tiny compared to gold. Even modest capital inflows create large percentage gains. Dual demand compounds this. Industrial demand grows alongside investment demand. Solar panels, electronics, EVs, medical applications, silver is indispensable. As capital flows in, the ratio compresses violently because supply is finite. Gold is larger and moves first, but silver follows explosively in the late stages of the cycle. Are you accumulating silver now? Physical bullion, miners, ETFs, or waiting for a pullback? This is critical. Your strategy determines whether you ride the cycle successfully or miss the move. Community engagement helps too. Discussing positions, ideas, and observations with other informed participants allows you to gauge market psychology and avoid emotional errors. Let's run the numbers again for clarity. Current starting point, gold at 5,042 per ounce, silver at 77.42 per ounce, gold-silver ratio 65.13, Dow approximately 49,500, Dow-gold ratio 9.82. Conservative targets. Dow-gold ratio falls to 2.5, implying gold at $19,800. Gold-silver ratio compresses to 19, implying silver at 1,042. Timeline, 4 to 7 years, roughly 2030 to 2033. Risk factors include deflation instead of inflation, government intervention, timing misalignment, gold-silver ratio failing to compress as expected, and Dow-gold ratio stabilizing at higher levels. This is the full picture. The bullish case, the bearish case, the math, the ratios, the timeline, the confirmation signals, all sides covered. No hype, no fear-mongering, just data. 2 ratios, 2 extremes, 1 mathematical conclusion. This framework shows why 4-digit silver is not speculation. It's a historical pattern repeating under favorable conditions. But let me stress something again. This is not financial advice. I am not a licensed advisor. These are observations, historical patterns, and math-based insights. Your decisions must reflect your personal research, risk tolerance, and financial situation. Plan responsibly. Know your time horizon. Understand your exposure. Stack with money you can hold long-term. Trade with discipline if your strategy is shorter term. Volatility will test your nerves. Patience will reward you. Final takeaways. The Dow-gold ratio is in a historically extreme zone, pointing to significant potential for gold. The gold-silver ratio is historically elevated, suggesting silver has enormous upside once the compression occurs. Together, these 2 ratios mathematically support a 4-digit silver scenario over the next cycle. Corrections and volatility are expected along the way, but the underlying thesis remains intact as long as confirmation signals hold. Now it's over to you. How are you approaching this cycle? Are you stacking silver physically, investing in miners, trading ETFs, or observing from the sidelines? Share your strategy in the comments. Are you prepared for volatility? Are you waiting for pullbacks? Are you skeptical or convinced by the ratios? Your engagement and insight help build a better understanding of the market psychology surrounding precious metals. To summarize one last time and make it crystal clear, we start at gold 5,042s, silver 77.42, gold-silver ratio 65.13, Dow 49,500, Dow-gold ratio 9.82. Conservative mid-cycle targets, Dow-gold ratio 2.5, gold 19,800, gold-silver ratio 19, silver 1,042. Timeline, 4 to 7 years, peak roughly 2030, 2033. Confirmation signals include Dow gold trend, central bank gold purchases, physical silver premiums, debt and inflation trends, and gold-silver ratio compression. This is the complete framework, covering risks, confirmations, historical context, and math. 2 ratios, 1 conclusion. Silver to $1,000 is the mathematical outcome of a full-cycle reversal, assuming history repeats. Corrections will test patience, but the overall trajectory points up. Remember, this is not hype, and it is not guaranteed. It's a logical conclusion derived from historical cycles and current conditions. Understand the math, manage your risk, and position responsibly. This is a multi-year opportunity, not a quick flip. Stack or trade accordingly. Watch the ratios, watch the signals, and let the data guide you. The math is clear, the history is consistent, the conditions are present. The outcome, based on past cycles and current data, points to 4-digit silver. How you act is entirely your responsibility, but now you have the full picture.